In this video, we're going to talk about error analysis, and this is a series of takeaway videos, important takeaways that I'd like for you to leave my class with. And the idea of error analysis can be done many ways. This is just one way in which I process the information, and maybe it can help you organize as well. So, the first thing I think about is what was the error that was made in the accounting books. And then once I think about what that error was, then I think about the effects that it had on the financial statements or whatever report that you're looking at. And then finally, what is it that I need to do to correct that error? Okay? And it might help to do some T accounts. I just threw a few T accounts here, but for me, I like to visualize in order to see what it is that I need to correct. So I have three simple examples here just to illustrate how it is that I go about this. So let me put A, B for this one. That way we can use it as a reference when we discuss this. So look at letter A. It says recorded depreciation of $100, and this is, by the way, in X1, in year X1, when it should have been $350. Okay? So the error made, and there's different ways to analyze this. This is where you have to choose how you want to do it. But the error made was that you under-recorded depreciation. Okay? So there's one way you can go about it. You can do the original $100 journal entry. Okay, and then think about what amount you need. That's probably the easiest way to go about it. Or you could just think about the fact that $250 was not recorded. So let's go the first route, and maybe we'll do that different approach for another letter. So here's what we did. We did depreciation expense for $100, and then accumulated depreciation for $100. Okay, now we know that it should have been $350. So I'm going to go ahead and do a T account here. Here's the expense for $100. And then in the assets area, we should have something called accumulated depreciation. And that we did for $100. Okay. So we're saying that really it should have been a balance of $350. Is what we're saying. Okay, and then when I go over here in the expenses area, that too should be a balance of $350, but we didn't do that. So this is where we would like it to be. So how does that naturally affect our income statement? Well, expenses are going to be understated, right, by $250. And then the other side of it is that the accumulated depreciation is supposed to reduce assets, and we should have reduced assets by $350, but we did not. So because of that, assets are overstated. Okay? Overstated by $250, the difference. And for me, this is just the easiest way to think about it. I look at the incorrect journal entry, what it's missing, and then that's how I analyze how it's affected. So what do we need to correct this in year X2? Because potentially what we're seeing is that we did this error in X1, and now we find ourselves in X2, and we need to correct this. So you might have to think about the fact, or you might have to deal with the issue that you've closed the books. So if you've closed the books, you no longer have that expense, and you might have to go to retained earnings. But let's keep it simple here. Let's just say, in this period, we're going to add $250. This is the correcting journal entry that we need. We need a debit to expenses for $250 and a credit to accumulated depreciation for $250 in order to get this to where we want it to be. So my correcting journal entry is going to be expense $250 and accumulated depreciation $250. And that will be it. So here's technically, the error made is that you recorded less, and then here's the correcting journal entry once you find out about the error. So that's for letter A. Let's look at letter B. Okay, so let me delete some of this stuff. Okay. Actually, let me put it on pause and then I'll come back. Okay, so now letter B. We later find out that we incorrectly recorded sales on account for $500 in X1, in year X1. So let me add that little detail here. In X1, that should have been recognized in period X2. Okay, so this was an error of premature revenue recognition. So what was the error that we made in X1? We did accounts receivable, 500, and then we did revenue, 500. That was the mistake we made. So naturally, revenues are going to be overstated by $500. And then the other item that's going to be affected is going to be your assets are overstated by 500. And then since your net income gets closed into owner's equity, then your owner's equity is also going to be overstated by 500. And by the way, I might have forgotten to do the equity component in letter A before. So when I stated that assets were overstated by 250 because of letter A, and expenses were understated, then what that means is that owner's equity also would have been overstated by 250. Okay, so we find this out and we're trying to correct this. So naturally, what do? You just look at that original entry and say, okay, that's the error, so let me just reverse that entry. Revenue 500 and then credit AR 500. All right, so the idea with this breakdown here is not so much that you have to follow these steps, obviously, but it's more about stepping back and think about a logical approach whenever you have errors, okay? So it might be that you like this 1, 2, 3 or 1, 2 system that I have here, or you might come up with your own system, and that's fine, okay? As long as you have a process where you have a way to logically go through the steps and figure it out. All right, so let me clean this out and do letter C. All right, in letter C, we're told that a physical count of inventory in fiscal year X1 was incorrectly done. Because of this error, $600 of inventory was written off when only $200 should have been written off. So in other words, at every period end or every year at least, you do a physical count. So let's say you, just to illustrate here, you did a physical count and it came out to be 10,600, the physical count. And then your GL said 11,200. So this is the information that we are using in order to think about this $600. All right, so if I do a physical count and I notice that there's only 10,600 and my GL says that there's 11,200, then the difference, or 600, is what I have to write off because my GL is overstated. But what complicates this one here is that it should only have been 200. So most likely the physical count was done wrong. In other words, the physical count should have been 11,000. For this, it could be other scenarios, but just for you to understand how this works out. So if the physical should have been 11,000 because we found some other inventory that we had not counted, then the amount that should have been written off is only $200. So here, let's go ahead and put in the amount. Okay, so a couple things, sorry. Here I analyzed by writing $100 as incorrect. You could have done the incorrect, this is the other approach that I wanted to talk to you about, and it's whatever you feel more comfortable with. You could just write the difference as the incorrect amount. In other words, we were short 250, right? So in theory, in theory, and this might seem complicated for some of you, in theory, this is the wrong journal entry. It's not intuitive. In other words, you're understating expenses and you're overstating assets. That would have been the way to analyze it a different way. But it's probably counterintuitive for some of you. Okay, but I'm gonna do that anyways right here, because we wrote off $600 when in fact we should have only written off $200. So the error here is the difference, $400. So I could just think of the error as having taken out too much out of inventory. I took $400 too much out of inventory. And then I'm sorry, I got to do this differently. Actually, no, that's fine. So yeah, I took too much out and I recorded too much loss. It's another way to look at it, okay? In other words, instead of rewriting what actually occurred, you rewrite the difference, the error itself, okay? And for some of you, you're not gonna like this approach, but I'm just giving you a different way of thinking about it. So I'm thinking about this one that way. I'm saying, all right, we recorded 600. It should have only been 200. So the error made was that I recorded too much loss and I reduced inventory too much. And when I do that, then I come over here and I say, well, my expenses are overstated by $400. Obviously, net income is going to be understated. And then my assets, I should not have done this. I should not have reduced assets so much. Well, my assets are going to be understated by $400. Okay, so naturally, owner's equity is understated $400. So what do I need to do? I need to correct it by increasing the value of inventory and reducing the loss or on the inventory. Okay. So don't get caught up in the details here of how I went about this analysis one way or the second way, or how I did this the second approach. The idea here again is for you to have a systematic approach in handling errors. Okay. Think about what error was made. Think about how that affects the reports that you're looking at, and immediately think about how you're going to correct it so that those reports are correct. All right, this concludes the video on error analysis.